First question is from Shan, and he says, "Thanks, Reed. Congrats on your success. It's amazing. How do you compete for investors? There are so many syndicators out there who are providing the same returns and same concept, but what makes you different from other syndicators? How do you attract investors?"
Love that question. And it goes down to two things: mindset on abundance, right? And second is story. Through the brand I created, which is my story, coming to America, yada yada yada. Again, it's not a boast; it's a story to help me build a brand. People are attracted to that, right? People are attracted to my values that I hopefully can portray to them, and through that, and what we portray at Wildhorn Capital, and through that, there's a lot of money out in the market. Yes, you're correct. There is a lot of syndicators. It seems like every man and their dog are syndicators these days. But again, when you have that abundant mindset, you have a certain value set and story, people are going to be attracted to you, and people come because they've heard the story and said, "I like what you have to say, and I like your values in which you lead your company on. So I want to invest with you." That is how you attract investors, and it's through consistency of saying that story, of telling your values to your investors, that you will attract the right type of folks. Remember, there's just a lot of money in the market, right? You could have 500 investors. You'd have 100 investors all investing $100,000. That's a lot of money to go out and start buying properties with. So you don't need to be Tony Robbins or Tim Ferriss or the big wigs of trying to attract leads and investors. You can have a small following and a tribe of people that love what you do because of your story and your values, and they're going to be with you forever, right? And that's the ultimate goal. So through attracting investors, it starts with what's your story. And we're all standing on a mountain of value. Don't think that, oh, well, Reed's got it easy because he came from Australia, and he, blah, blah, blah. Go out, and if you need to change your story, if you need to change your life, change your story, right? So if you want to start attracting people, you are standing on a mountain of value. You just have to tap into what that story is in order to start, belting it across the airways, and you will slowly start to attract people. And I know that I'll lose investors to probably folks on this webinar, but that's okay. There's plenty of people out there. There's plenty of fish in the sea, and I don't need to have it all, right? I just need to have what I want to build in a sustainable way, and that's where I went back to before. I don't need the $2 billion under assets under management. That's all ego. I need a sustainable business that my investors are going to be happy with their returns, and they're going to come in. You're going to come back, return time after time, and they're going to refer investors to me over the long term. And when you have that long-term vision of your company and of growing a business, then ultimately you're there for the long haul, and people can see that and they want to invest with you even more. So, yeah.
That's great advice. Yeah, removing the ego and then having confidence in yourself. People are just automatically attracted to that. So that's really great advice. George asks, how much more can you make if you do your own deal versus investing with someone else who is already doing deals? So,
I think you mean from a syndication versus LP versus GP. I think that question is about, right?
I believe he's asking, like, if you were to put your own deal together, like the triplex, for example, versus syndicating out of the deal.
Yeah. Okay. Look, access to outside money is great, right? And syndicating happens across the board, right? Think of Facebook or Google. They were great ideas back when Zuckerberg was in his dorm. He had to go attract capital in order to grow it. So he wouldn't have grown Facebook to where it is today without having outside investors. The same goes when you start with a good idea. Maybe it's proving yourself on a triplex. Yeah, you're not going to smack it out of the park the first deal, and you shouldn't aim to smack it out of the park the first deal. Your first deal that you do is about getting a foot in the door and getting it to a base hit. That's all it is. And it gives you that confidence. Remember, you don't get to deal number 10 without doing deal number 1. So when you do those first smaller deals on the front end, it proves to you that you can do it. It proves you've got a concept. Then you can go out and start raising capital, and then you can scale that business. And remember, I would rather have a small bit of a lot than a lot of nothing. So understanding that getting started, you have to get started with the right mindset, but also knowing that you can prove it to yourself in order to go then attract capital into your deal. So the short answer is you make more money when you scale it to a larger point than you do trying to do your deals on your own.
Awesome. Good stuff. Kago, also from LA, talks about, or he asks, what are your thoughts on ground up construction, and is that business plan on your radar?
100%. I'm more comfortable in ground up construction, actually, and that's where the world I come from, right? The civil engineering. I spent 4.5 years here in LA building high-end multifamily for a big developer here. So I have that experience. I've got that structural engineering experience. I've worked on the London 2012 Olympic Games. I come from that world. So think of the food triangle, right? The food triangle where you have the good foods on the bottom, the vegetables and the nuts and the fruit, they're all on the bottom, right? The bottom level. And that should be your cash flowing level, right? You should always try to put cash flowing deals as best you can into that level in order to get to some level of sustainable revenue coming in. The next level up might be sort of flipping houses. It's a little bit short-term money, hard money loans, that sort of stuff, where it's a little bit over the short period. And then at the top of the triangle, the most, not the bad foods, but the most risk is ground up construction. And you need to know what you're doing. In ground up construction, the reason only as you graduate up that pyramid, you will, and the developers that I've worked for in the past, they started with small triplexes and duplexes and got confident and started pushing their boundaries and were able to get to the top of that triangle, because it is the most amount of risk. But when you start to understand how you mitigate that risk through land entitlements, through mitigating construction risk, through mitigating schedule risk, through mitigating debt risk, you need to all understand the process of ground up construction. So, yes, I think ground up construction is very lucrative if you know what you're doing. I wouldn't just go and start there, because everyone I've worked with in the past have started from doing smaller deals, syndicating deals, going to cash flow, and then finally working their way up the ladder. And remember, to have a diversified portfolio, you're not just stopping doing your cash flow deals. You're still going to be adding deals into that bottom layer all the time. But if you start to graduate to doing those, we'll call them trophy properties, ground up construction, which take a little bit longer. Doesn't just happen over 1 or 2 years. It could take 3 or 4 years by the time you tie up a piece of dirt and title it, get it through planning approval, and then get it constructed. That takes risk, right? And so thus a lot of capital has to go out the door before you get an ROI on it. So you will still have some deals in your cash flowing section, which will keep paying the bills and keeping the lights on. And then you might do some ground up construction deals that take a little bit more time. You have to invest money and you put it out of your bank account, and it comes back to you like a boomerang in 3 or 4 years' time. So I do like ground up construction. It is very, very lucrative when you know how to do it right. So yeah.
That's awesome. Irish Kevin, he asks, what is the recent history of cap rates been in the Austin market? Where is it going to go due to COVID? And then do you think it'll change at all once a vaccine introduced too? I guess he's asking, do you think there'll be any expansion in cap rates in the Austin market in the meantime?
Yeah, so historically, you could go back 20 years ago, right? And yeah, cap rates were 6, 7, 8%. It was a very boom bust market, Austin. But through that sustained growth and investment in local infrastructure in order to attract businesses from the municipality we aren't in today's Austin by a fluke. It happened through the last two decades of sustained investment by the municipality in order to attract those types of businesses and grow the city sustainably. So when you have now a good base, that is going to then propel the city for another. I've looked at the economic business plan for Austin, and they're expecting to double the population in the next 10 years. And that's all through certain types of attracting different types of businesses. So that is, again, goes back to that supply demand that I was talking about earlier. And the transition from a secondary market into a primary market, because of all the businesses, it's going to turn into a coastal market, because you'll have a lot of people wanting to move there. When you have a lot of people wanting to move there, think of New York City, right? A lot of people want to live in New York City or Manhattan. It's never not going to be Manhattan. Austin's on that similar trajectory. So when you have low interest rates, high demand, low supply, cap rates are going to be relatively low. There may be a slight swing back with COVID, but on the other side of COVID is that multifamily has really done quite well in markets like Austin because of the adaptability of tenants and renters to virtual leasing, to be able to work from home. And so our assets in Austin have done really, really well. We've collected well over 98% month on month for the last quarter through COVID. And we're seeing also now bigger coastal firms coming, and we're competing against more people actually in the Austin market than we did pre-COVID. So to specifically to Austin is that people are starting to pay attention to it through the announcement of Tesla moving there, through the announcement of certain industries moving there. And that is tweaking the coastal market, big investors to come and start looking at the interior. And we're actually competing now against those guys, which is only going to drive up competition, coupled with the fact that multifamily is doing a lot better from a commercial asset point of view compared to retail, hospitality, office space. And so on the long term, people are going to keep flocking to multifamily for a safe haven, in my opinion, across the world, right? Because people, two human needs. You need a roof over your head and you need to put food on your table. So paying the rent is really, really important. And so I think with the combination of how multifamily will ultimately fare through COVID, I know we're still in the midst of it right now, but I think given the data in Q2 from our portfolio at least, we think it's going to be very, very attractive coming out of COVID, coupled with the fact of the supply demand, people continuing to want to move to a place like Austin. So product still needs to be built, and the existing product you have, people want to rent from you at a higher premium, like coastal markets, like Manhattan. Combined with the fact that you're going to have a lot more investors in the hunt for moderate cap rates in interior markets like Austin, Texas, is all going to force cap rates to continue to be relatively low in the environment of low interest rates as well. So a lot of things in there that I've said, but overall my confidence is good for a market like Austin, Texas, given all that's going on.
Awesome. Yeah. Abimbola asks, for first-time investors, can we venture out of our hometown, or should we stay close to home for our first few deals?
Up to you. Whatever you feel confident in. Like for me, I remember getting on a Greyhound bus to Syracuse, New York, because it was affordable. That was the only reason I could drive there. So, that gave me enough confidence that if I needed to get there quickly, I could. Right. So ultimately, I'd love to, and I'm actually planning on moving to Austin in the next couple of years. I'd love to have deals in my backyard here in LA, and I eventually probably will in the future. If you can find deals in your backyard, that's great, because as someone that lives in a certain neighborhood or MSA, where the right side of the street is. You know where the path of progress is, because you drive it every day. Now, if you're in a really expensive city like New York, like I was, then yeah, you need to go find other markets that are more affordable if you're looking for cash flow. But my number one piece of advice is, if you can invest in your backyard, do it. If you can't, then try and maybe look for some other markets that are within easy reach of where you are, so you can get there, be boots on the ground, consistently go there, start learning the market, start meeting with brokers, start understanding where the path of progress is, and try and get in front of it. So yeah, it just depends on where you live across the country.
Awesome. Kygo asks, you mentioned Texas being your focus, but what other markets have you looked at that caught your eye, secondary, tertiary markets, or have you kept the focus on those that you're currently in?
We looked at Atlanta, Georgia, about 18 months ago. And what we found was, it goes a little bit back to from the last question. What was our competitive advantage? We went to Atlanta. We didn't know anyone. We didn't have a competitive market advantage. The reason we're competitive in Austin is because Andrew grew up there, right? He lives there. He breathes it. He's playing golf with the brokers on the weekends. So we have that competitive advantage. But when we decided to look at Atlanta, we really liked the Atlanta market, but we're just going to be another person in the line, right? We weren't anything special. We're not going to get any extra treatment. So we decided to double down on our market for at least the next 3 to 5 years. But I've liked other markets like Phoenix, Arizona, depending on where in the cycle you picked up properties in Phoenix. I mentioned Atlanta. I know Charlotte, North Carolina is a really attractive market. I like markets like Asheville, North Carolina. I like Columbus, Ohio. But again, I don't want to be spread too thin and not get the right deal in a particular market, because I'm looking across so many different markets. Like, focus on one market, grow that, and then once you got to a certain scale and attracting right capital, we will probably only move to a new market if our capital partners say, hey, we want to be in Denver, or we want to be in Seattle, or we want to be in wherever. So for right now, it's what's your competitive advantage in a particular market, and then grow that competitive advantage over a period of time and be focused on one market before you start expanding into multiple different markets.
Awesome. So I put the question for Preeti, and I wasn't sure if Preeti was asking about syndicating your own deal or about about Reed's deals in general. So if you could let us know, but I'll move on to the next question for Norm. For Reed, do you consider local boots on the ground a necessary part when syndicating from out of state?
Yeah,
what would be the roles?
Yeah, I do. I look, the part of the reason Andrew and I got together all those years ago was because I needed that competitive advantage. It goes back to, he had something that I didn't have. He was the hustler on the ground that was going and harassing brokers to go for lunch with them. So for me, trying to do that by myself, getting on a plane, flying in there, trying to meet up with brokers, now that could happen over time. You definitely can do it, but it goes a lot quicker if you have someone who is local to the market and can give you that insider knowledge on the growth of a certain market. So I encourage people to, it goes back to that partnering. And before I partnered with Andrew, I'd partnered with many other people, and you get to a stage where you understand partnerships and you're comfortable with complementary skill sets. You're comfortable with alignment of vision and values. And that is really what's important. And if that can be someone who is boots on the ground, then that's ticking all the boxes, and hey, get them on board and see how you can work out a potential partnership. So yeah.
Yeah, that's great advice. Oluwafemi, I hope I got your name right, asks, how do you get multifamily deals? There seems to be so much competition out there. What is your recommendation on how to get good deals?
It goes back to the last couple of questions about having those boots on the ground, sticking around the hoop in a market that you underwrite deals. You're talking to brokers consistently. You're going out, you're having lunch with them, or playing golf, or doing something unique with brokers. It's really getting in those brokers' pockets and becoming mates with them, so you can get the first sniff on a deal. Like, we've bought, out of the 9 deals we own, I think 4 of them are pre-marketing deals. So we got a bite of the apple before the rest of the market did. Now, we would only be there because of all the work that Andrew did, again, being my business partner in Austin. And I always joke that, he shakes the lemon tree and I determine if we make lemonade or lemon juice out of it. So, it goes back to sticking around the hoop, knowing the local people, members of council, understanding where the growth is in a certain market. And you can make money in any market, right? It doesn't have to be just in multifamily. It can be in adding value to any particular piece of dirt. And the way in which you go and execute that can vary, right? But it really comes back to being consistent in a market and hanging around the hoop, so you can get those shots in when they come your way.
Good stuff. So George had a question. So anyways, his question was, if I had $1 million and wanted to buy a $3 million deal, I would make X. What if I just gave you the $1 million? What would be the difference in my return? I'll kind of take a stab at it, and feel free to hop in, Reed. George, so if it's the same deal, and you were, I was going to syndicate it, or Reed was going to syndicate it, it would just, the only difference would be, our asset management fee and our sponsor fee. I don't know Reed's structure, but a typical structure is asset management fee of 1.5% or 2% is pretty typical. Some people it's a little more, a little less, and then on the sponsor fee, you're typically around 20%. Some people it's 30, some people it's 10 or 15. So it just kind of depends. But so that would be the difference between. But if it's someone that's syndicating the deal, then it's kind of, it's more hands off for you. It's more mailbox money. So I don't know, Reed, if you had anything you wanted to.
No, yeah, look, from an apples to apples point of view, in just a numbers point of view, you'd make more money doing it yourself. But you've got to ask yourself, well, do I have the expertise? Am I having the first crack at these deals unlike a syndicator would? And do I want to roll up my sleeves and do all the work, or do, per what you mentioned before, Dustin, armchair money or mailbox money? Do I want to just place my $1 million and get a 7% return on it? And you're at a certain stage in your life where you don't want to have to hustle. And so all those things play into it, coupled with the fact that will you do as good a job as someone who's done it before and has a really long track record? And so if the answer is no, then maybe you got to give up some of the deal. You get a lesser return, but the deal is more likely it's a lower risk deal because you aren't trying to figure it out as you try to manage it. So there's a couple of questions in there that you need to answer from a personal point of view to really assess which path you go down.
Yeah, that's great advice. And it's very competitive in this market. So having a team around you helps you be able to streamline and make everything efficient too.
Correct.
We've been filtering through deals for the past year, and we've only submitted offers on a handful of them. So having a team that can fully understand what you're getting into is really helpful too. Kygo asks, how involved is your wife in your business, if at all?
She's not. She's actually an interior designer. She has her own business. She's coming on I think 2 projects to help us with the interior design of some model units and some leasing centers. So not greatly involved, but she's also a big champion of mine, as am I of her business. So it's really important, I think, having a partner in your life that, as you go home, who understands what you're trying to build. And don't get me wrong, at the beginning, we weren't on the same page in terms of what I was trying to build and what she was trying to build, but you grow as relationships grow. But having a partner who can support you is really, really important as you go down this journey of entrepreneurship.
Awesome. And I'm looking at Irish Kevin's question here. So Reed had touched on this. He said, so Kevin's question is, being out of state or a sponsor, how do you find the current property manager, and how are you able to come to trust them to do the right job? Have you had any issues with current management? Any issues with properties in portfolio?
Yeah. So back to what I said earlier was, the seat warmers, the BMW seat warmers, like really what it boils down to is attracting talent. You can underwrite the deal, and as everyone knows on this webinar, deals are thinner than what they were 10 years ago. So you need to make sure that you have trust in your team, and making sure that team is attracting the right talent. Part of one of the biggest struggles in our portfolio is getting the right property managers in the bum in the seat, right, for a particular property. And if you have a property manager who doesn't understand how to do renovations or doesn't understand how to manage a property whilst renovations are going on, you can get out of the gates as a stumbling blocks, right? Or you can stumble getting out of the gates. So really who is in the key positions on your property is super important. And that boils down to who is the property management company and how are they attracting their talent and their employees through good culture and the company values, making sure people are excited to come to work, all that sort of stuff. As an owner, as an asset manager, my role is it's hard, right? Like I pay for their payroll, but I also want to they're not directly my employees. So when I get on my weekly calls with my teams, I'm trying to encourage and shine the spotlight on my property managers so they can take ownership and they feel like it is their deal as much as it is my deal. And that's been the hardest part. It really boils down to people. And then we're in the people management business, whether it become to investors or property managers, to make sure that people understand their roles and responsibilities and want to rock up every single day and manage the asset as if they own it. And that's been probably one of my biggest struggles, building out this portfolio, and will continue to be, right? There's no silver bullet. You're not just, I've got a property management company, set it and forget it. No way. Like there's no such thing as passive investing when it comes to making sure your asset is run correctly. And I look over every single numbers every single week, and I'm very diligent about that. And I hold their feet to the fire, but I hold it to their feet to the fire in a way that they are encouraged, and I'm not belittling them. It's more, hey, why is this, or how come we missed that lease because of X, Y, Z? And encouraging them to take ownership is super important as an asset manager. And really, that's when the deal starts, right? You might underwrite a deal and get it under contract, but once you close on it, that's when the hard work starts. And that's where you've got to make sure your team on the ground at the site is got your best interest at heart, and make sure that they manage the asset as if it's their own.
That's good advice. We're going to ask this final question here. So after you answer this one, if you wouldn't mind scrolling through and picking your favorite one so we can pull out a winner for your book. But Cornelius asks, have you ever considered creating your own property management team?
100%. Yeah. And we're getting to a stage now where we've grown the portfolio through friends and family and small $50,000 checks. And now we're starting to attract bigger private equity companies that are looking at us. The question has come up, when are you going to bring property management in-house? We think personally it's around 3,000 units. It becomes a scalable product where when you flick the switch, it's not like 2,000 is a little bit too small, but 3,000, you're starting to get that scale again. And I know a lot of companies that have get to that 3,000 to 4,000 and then make the switch. So we will bring it in-house eventually. Going too soon can hurt you because it just becomes too much. You don't have the revenue coming in, and you lose money on property management. Again, goes back to attracting the right talent. So when you do start your own property management, who are you going to attract? And it's about how you're going to go and set up your business, your systems, I should say. So for us, I've thought about it because that's what I do, is systems, right? So, the two things I would do, property management is not a sexy game. You have to do it in order to reduce your expenses. But how do I go out and create a property management company? Well, I would do it one of two ways. One, I would acquire a small property management company, or two, I would find, which I've got my ears close to the ground, a gun regional manager who's currently on our portfolio or on someone else's portfolio who has a bit of entrepreneurship in them, that they want to start their own shop. And we would sort of, as we joke, you bring them on and be the throat to choke. And they could build out the systems for us. So really, it's probably going to be the latter that we end up going down the path, because not a lot of property management companies come up for sale, and you're sort of buying their systems. So for us, we will eventually, probably in the next 2 or 3 years, we'll have to bring that in-house as we grow the portfolio over time. It just makes sense, and it helps attract bigger checks and bigger LPs. So yeah.